If you've ever had to close a profitable trade eventually in loss, then this video is for you. Let me show you what expected and realistic targets mean. And that is what you've been missing all along. Come closer, let me show you what it is. Between expected targets and realistic targets is very simple. Expected targets are the area you're waiting for market to get to. You are waiting for markets to get there. And an example of this is external liquidity. If you do not really know what external liquidity is about, I've dropped a video on my channel, so you can go check them out. And also extreme risk to reward. I mean, 1:20, 1:30. That is expected targets. You are expecting that market would get there. While realistic targets are the areas market is willing to get to. For instance, the inducement levels, minimal risk to reward. When we talk about minimal risk to reward, we can be talking about 1:3, 1:4, 1:5. It is very real for markets to actually get there within a short period of time. That is a realistic target. Now, it is not compulsory that you put all your trades and then you close it at realistic targets. You can close 60-70% at realistic targets and hold the rest till expected targets. So I'm going to be showing you on charts what I mean by realistic and expected targets. So let me show you some of the trades that I took and how it turned out. So I'm going to be going to volatility 101S, which was a trade I think I took 2 days back. Volatility 101S. All right, so on the 2 hours time frame, I made an entry on this particular market, which is volatility 101S. I made an entry around here. I made the entry here. My entry was here. My entry was around this low, and my stop loss was at this high. It was around here. And my realistic target, listen attentively, please. My realistic target for this particular trade was this low. Yes, this low. This was this low, which is 1:4.22. Yes, it was 1:4.22. And you might want to ask why it is a realistic target. Now, if you check through this, if I want to buy this particular market, if I want to, make a buy continuation, because obviously our last record structure was to the upside. So listen, our last record structure was to the upside. So even if I was expecting that market would buy, I would be expecting market to take this low, which is an inducement area. I would be expecting market to take this low, which is a valid inducement area, okay? I would be expecting market to take this particular low. Why? Because we had our short-term break of structure to the upside. This was the low created after it, and you can see that this low did not dip back into this area. This low did not dip back here, right? So this is a draw of liquidity here. If you check on the 4 hours time frame, you definitely see probably fair value gap or something. So let's just check. You can see we have fair value gap there. You can see there we have fair value gap. So I'll be expecting market to come inside here to make that buy continuation. Is an inducement level. Number 1, it is an inducement level. Number 2, my target was very real. I think I made a target of 1:6 or 1:7 because my stop loss was on the lower time frame. My stop loss was not up to this. I think it was on the lower time frame. Yes, I made my stop loss. So it was around 1:6. I think it was around 1:6, 1:7. It was not up to this. So my realistic target was this low. Now, if I was going to, bring out an expected target, if I was going to be looking out for an expected target, of course, immediately this low is broken. I am expecting it to come back and reach this low. So market is not telling me it wants to go there yet. Market is not giving me the signal that it wants to sell that much yet, because if there is a signal I'm going to get, it should be at the break of this low. But inside me, I am expecting that this low will be broken. Markets would come, take this low. Markets would come, take this low. So my first expected target would be this low. It would be this low, which is going to be about 1 from my entry, my stop loss and everything. It's going to be like 1 ratio, maybe 17, 18 or 1:20. That is an expected target. But my normal realistic target, that I know that even if market is going to continue the buy, it should get to this draw of liquidity, take this low as an inducement, then make that buy continuation. Market has not given me that move yet that we want to start selling to the downside. Okay, so that is why I am going to stick with my realistic target, which is still very okay. Imagine me taking out 70% of my entry at this particular place, then my expected target, I am expecting it to get to this low. It is going to be a win-win for me. However, I'm going to be on the safer side. I am not going to have markets go in my way and reverse back. Hope you're getting what I am saying. So I'm going to show you another asset that I took, which is on volatility 251S. I'm going to show you my realistic target and my expected target. So on this particular volatility, I was selling. Yes, I was selling on this particular asset. I think it was on the 30 minutes or so. I was selling yesterday on this particular asset, and it hit my realistic take profit, but it could not get to my expected take profits. Rather, it hit my realistic take profits, but it could not make it through to my expected target. So I actually sold around here. Yes, so I placed the limit above this high. I placed the limit above this particular high when I saw the market making this particular move to the upside. I knew I was expecting market to break this high, but I was not expecting it to take a particular area here, I think on the lower time frame. So what I did was limit at this low, then my stop loss was around there, this particular high, this particular week. It is very obvious on this time frame that there's something there on lower time frame. My realistic take profit was here. It was this particular low, this low, because that is my inducement level. No matter what, even if I am expecting market to buy, I am waiting for it to take this low, which is an inducement, and come back to this area, which is a draw of liquidity to buy, right? I was expecting it to come to this area for a buy continuation. So this inducement is my realistic take profit, and that was where I placed my realistic take profit. Yes, I think my risk to reward was lesser than this. I think I closed a little bit lesser than this. I think I closed around 1:6 or 1:7. I can't really recollect. So my realistic take profit was this particular low. This low was my realistic take profit, while my expected low, I think I get this. Yes, I get this particular assets on my signal channel. My expected take profit was here. Well, it was this low literally. This was my expected take profits, that immediately we have a break of this low, markets would come back and clear. We were reacting at a very solid pre-O high for me. We were reacting at a solid pre-O high for me. So I was expecting that this low would be broken and markets would get to this low. Remember, I said expecting. Market has not done it, but I was expecting that market would break the low and will come as low as this. This was my expected take profit. But my realistic take profit was this inducement level, and I took out, I think, 40%. Yes, I took out my 40% at this particular low and this low. I was expecting it to take out this low so that we could get to my expected take profit. So that is the difference between your realistic take profit and your expected take profit. After this video, I really hope you are going to be looking out for expected areas and realistic areas of the market so that you can know what exactly you are doing, and this is really going to help you. So do not forget to join my community for tips and every information about trading synthetic indices. Have an amazing and profitable day. Bye.